All right, so let's get started here. Well, hello, everybody. Welcome. Thank you for joining in the webinar, whether you're referred from an attorney or a mediator. Maybe you saw me on Facebook. I appreciate you taking the time to join in. My name is Jeff Weaver. I'm a mortgage professional, and I work almost exclusively with folks who are going through a divorce that involves a marital home, particularly if you're looking to stay in the home. And in working in this space, often find that people have the same types of questions about what happens to the house in divorce. How do I qualify for a mortgage? When should I start the process? And so we put together this webinar with the intent of giving you information, more information, to help you make a more informed decision about what to do with the house and how to avoid some mistakes that we often see people making when it comes to the house in divorce. You basically have one shot to get this right, because once you sign your settlement agreement, once you get that divorce decree, it is extremely difficult to go back and make changes to that. And so we want to make sure that you're doing the kind of due diligence that you should be doing to avoid some common mistakes that can end up being very, very costly. House mistakes are not easily fixed and not inexpensively fixed. And so what we want to do today is basically talk about the three options that you really have when it comes to the house. You could sell the house, basically do nothing, keep the title and the mortgage in place, or do a refinance and or buy out the other party. So when it comes to selling the house is really the most least risky option that there is, because you're taking that complicated asset and you're converting it into cash, and then you have those cash proceeds, and then you just split them in an agreed amount split. So this is the least complicated thing to do because you're severing all of that joint liability and everything. However, the house, though, isn't just a number on a balance sheet like a 401k or a pension. There are memories associated with that. You don't have Christmas memories with your 401k fund. And so we want to acknowledge that. And at the same time, we want you to be making the most informed decision, given all the complexities that are involved with the house. The other option is to keep the title and the mortgage in place. In essence, is to really not do anything with the house. This is the most risky thing to do, because at the end of the day, you can end up being legally divorced, but financially you're still married to each other. And sometimes that can be kind of a difficult road to go down. So typically the only time people are doing this is when they don't really have a choice. They either can't sell the house or they can't refinance. Now, today, we don't really see very many people who can't sell the house. We did maybe 10 years ago, and, home values plummeted and a lot of people were underwater. They had a mortgage amount that was, significantly higher than what their home was worth. Today, we typically see people who, for whatever reason, whether it's a credit issue or an income issue, they're not able to refinance the house. Now, we'll talk about a little bit more about qualifying with child support and alimony. But when you're going to keep the title in place, the concern is for the departing spouse is that will prevent them from qualifying for a mortgage to buy a house themselves. And I just wanted to just kind of highlight this. So both with Fannie Mae, Freddie Mac, and even with FHA, there's something called the contingent liability. So in your marital settlement agreement or your property settlement agreement, if it states in there that one spouse who's going to be staying will be responsible for the mortgage payment, taxes, insurance, and upkeep of the home, once you have a divorce decree, that's a court-ordered assignment of that debt. So that departing spouse, that debt doesn't count in their debt ratio if they were to go buy another house. Legally, they're still responsible for that debt. So if the spouse who is responsible misses a mortgage payment, it still reflects on the departing spouse's credit. And so there's some things that you want to do to make sure, making sure that mortgage payment's being made every month to protect yourself. But just because you leave the title and the mortgage in place does not necessarily prevent the departing spouse, the one who's moving out, prevent them from buying another property. And this is what we most often see is the one spouse basically doing a refinance. As part of that refinance, we do a new deed. At closing, that deed is executed to remove the other spouse, put a new mortgage and a new deed in one person's name. And what's important about this is that you really want to treat this transaction, keeping the house as a purchase. We'll talk a little bit more about that later. And then we're also going to cover about qualifying for a mortgage during a divorce, and then also using home equity strategically in your settlement. There are some unique guidelines with mortgages with respect to divorce. There's some things that you can do when you're getting a mortgage because of a divorce that you otherwise couldn't do. And so we're going to talk a little bit about these. There's some things that you can do as far as using home equity more strategically to craft maybe a better settlement for yourself, allow your attorney to be maybe a better advocate for you. And so we'll talk a little bit about that as well. So refinancing the marital home. So you really want to look at this like you're buying the house all over again. So when you bought your house, the first time that you did your showing and you walked into your house, your realtor was probably giving you some information about the house. They may have told you, well, this is on a really busy street. It's going to be hard to sell, or those power lines. So they started giving you information about the house so that you can make a decision about whether this is something that you wanted to pursue or not. Once you put an offer in and you went under contract, then you had a whole new set of inspections and all these documents that you gather. So when you got to closing, you had this huge stack of documents. You had the mortgage pre-approval. The mortgage company went out. They did an appraisal. You had a title company do a title search to let you know what liens were against the property. You had a home inspection. That inspector went through the house top to bottom and told you everything that was wrong with the house. Your insurance company, a lot of insurance companies right now, they're coming out to the house. They're doing their own inspection. So you got to the closing table on settlement day, and you had this huge stack of documents. You had all of these inspections and all these consultations, all to inform you about what you were doing or about what you were buying, with this big purchase. What often happens in divorce is that almost none of those things happen. And so what is typical in divorce is that you maybe get an appraisal done. You find out that the value is X. You show your attorney, here's what my mortgage balance is. And then you subtract the two of those numbers, and that's the home equity. And that's basically the value of the house as an asset in your divorce. It doesn't take into consideration other things that could affect the equity. And so you really want to look at this as if you're buying the house all over again, because there could be issues with the house depending upon the age of your house, how long you've been in the house. For example, in this area, stucco is a big issue sometimes. Stucco, if you have stucco on your house, anybody who does, stucco is a porous material. So when it rains really hard, that water penetrates the other side of the stucco. Now, when they put the stucco on your house, it has to be able to drain. It has to be flashed correctly so that when water gets behind gets behind the stucco, it has a place to go and it has a place to drain. Oftentimes that if they don't do the application of the stucco right, that water has nowhere to go and it sits between your stucco and the wall of your home, and it just kind of sits there and starts in the summer. It just bakes the inside of your walls, and you may not even know it. I've got a client who had a really large $1 billion home, and they had a stucco issue, and it was going to be $270,000 to fix that. Now, in a divorce situation, if the house is worth $1 million and you owe $500,000, and your attorney says, well, it looks like you have a $500,000 asset, but there's a $200,000 stucco problem, you don't really have a $500,000 of equity. You have $300,000. And if you're going to keep the house, that problem is going to be yours at some point. Whether it's not your problem until you go to sell it, or it's your problem before then. So keeping the house and treating it as a purchase, and just doing the simple thing of getting a home inspection can give you some information about the house and what the true equity is in the house. Because if you sold the house, that stucco issue is going to come up, and the sellers are either going to want you to come down in price or to fix it in order to sell the house. Another example, I had a client who they had a really nice $600,000 house, and we did a home inspection. And the house was an older house. It was built in the 70s, and the inspector found, because he went downstairs, it was an unfinished basement. He found some really small cracks in the foundation near where the chimney was. Nothing huge, nothing major, but he just kind of noticed them in the mortar. On the first floor, he noticed at the fireplace there was a small crack in the mortar on the fireplace that went from one end to the other. And so going outside, taking a look at it, what they found was that the chimney was starting to pull away from the house. Now, this has been happening very, very slowly over a long period of time, and no one really noticed it. I mean, you really wouldn't notice it unless you really were looking for it. But it was a $35,000 issue to get fixed. So it's things like that. An inspector is going to go from top to bottom of your house. It's going to tell you everything that's wrong with the house. And most often, the things that cost a lot of money are things that you typically wouldn't notice, like stucco. Like, you can't see that you have a stucco problem because the stucco covers it. You can't see behind your walls. It's only until they drill a little hole in there and stick a probe and see how much moisture is back behind your stucco do they find out that there's a problem. Or go up in, when's the last time you were in your attic looking around to see, if there's any, trusses that are cracked or something from ice damming. So getting a home inspection is a really good thing to do to protect yourself, because any big problems with the house, unless you address them now at your property in your settlement agreement, they're going to show up at some point, whether it's until you sell the home or before. So it's really important to, number one, to get a mortgage pre-approval as soon as possible. And when we do a mortgage pre-approval, we not only tell you what you qualify for, if you need to have child support, alimony, how much that needs to be in order for you to qualify for a mortgage, but the mortgage company is going to do some other things as well. We're going to get an appraisal done. So you'll know exactly how much your house is worth, from the bank. Our appraisals are a little bit different from maybe what your attorney might get. Your attorney might get an appraisal based on what the value was when you separated. But as far as qualifying for a mortgage, you want to know what the bank is going to qualify, what the bank is going to look at that. And there's a process that we have to go through. We have to order our appraisals through an appraisal management company. We can't just pick an appraiser out of a phone book. And the appraisals are good for 6 months. And so, we can get that so we know exactly what the house is going to appraise for. And that way we know how much you're going to qualify for, how much equity you'll have access to as well that you can use in your settlement. We'll do something else too, is we'll get a title search done. We'll see what liens are against title. If there's any other liens that you may know about. Most people have never checked the title or any liens against their house. And we'll also get insurance and stuff as well. So these kinds of things can help protect you in getting these things done as early on in the process as possible. There's a case one time where you had husband and wife were getting a divorce. They both had attorneys. There was a judge involved, and there was a court-appointed mediator. And they decided that it was going to be the husband was going to keep the house, and the wife was going to get the 401k. And so the husband figured, he has really good credit. He has good income. He didn't really figure there's going to be any kind of an issue with being able to refinance the house. The house was worth about $200,000. They owed about $100,000 on it. So it's about $100,000 of equity. The 401k was, kind of similar. And so they signed the settlement agreement. They got their divorce decree. They did the transfer of the 401k. The wife signed a quit claim deed. And then the husband went out afterwards to get a mortgage. He went to his bank to get a mortgage. The bank did something that nobody else had done. They went and they got a title search. And what they found was there was a $97,000 state tax lien placed on the house in the wife's name. Now, this kind of blew up his, the asset that he was getting. The house, it ate up all of his equity that he had. So of course he calls his attorney and they go back into court to renegotiate the settlement. And the wife's attorney said, well, look, title is a public document. You could have gotten this. You could have easily gotten a title search done in 24 or 48 hours, and you chose not to. So that tax lien, that's yours to live with because you didn't do the due diligence that you should have. And the judge agreed with them. And so this guy was out, the equity. He couldn't sell the house because he owed pretty much almost what it was worth. He'd have to come to the closing table with money, and he couldn't refinance because he had this $97,000 tax lien. So getting these things done ahead of time will really help you understand what your options are, any potential issues, because once you agree to something in your settlement agreement, if you're not able to, follow through with that, it's going to make it's almost impossible to go back and rewrite a settlement agreement. So when we're working with somebody, you want to keep the house, we want to get your mortgage, we want to get a mortgage pre-approval done for you right away, order an appraisal, get the title work done, get your insurance squared away so that, you're walking into that, you don't at least finish negotiating until you know exactly what you're qualified for and what you're going to need. I had somebody that came to me one time that it was after they signed their settlement agreement. Their settlement agreement just got signed, and she wanted to move forward and refinance. They structured the alimony for 30 months. Well, you have to receive alimony for 36 months in order for it to qualify. So we couldn't count the alimony, and she didn't qualify for a mortgage. So again, getting these things done is early on in the process as possible. So you and your attorney, or you and your mediator, or whoever, can be, well informed about the house and what you're getting and what those numbers look like. Is really, really important and helps you avoid really costly mistakes. So look at your house as if you're buying it again buying it for the second time. Let's talk a little bit about doing equity buyouts. So one of the things that's different about getting a divorce, as far as mortgage guidelines are concerned, what often happens is, let's say you have a case where the house is worth $300,000 and you owe $200,000. And there's $100,000 of equity, and you're going to split that 50-50. So in order to keep the house, you have to give $50,000 to the departing spouse. So what happens is you go to your bank and you say, look, I need to refinance my mortgage. I need cash out. I need $50,000. Now, to do a cash out refinance, there's two things. So first of all, a cash out refinance, the interest rate is higher than a rate and term refinance because there's more risk to it. People who take cash out of their house are more likely to go into foreclosure. And so there's Fannie and Freddie have a risk adjustment because of that. And so you pay a little bit higher interest rate. Also, you're limited to 80% of the value of the house. That's the most that you can take out for a cash out refinance. Well, in this case, the bank is going to tell you, I'm sorry, we can only go to 80% of the value of the house. So if you need $50,000, we'll be able to go 80% of 300,000, which is 240, and there's going to be another X number of thousands of dollars for closing costs. So you're going to be short. You're not going to be able to get the cash that you need to make this $50,000 buyout work. So that can complicate things, or it can maybe even force you to sell the house if you're not able to do the refinance. So with Fannie Mae, Fannie Mae has something called an equity buyout, and it's different from a cash out refinance. And what it allows you to do is it allows you to do a refinance as a rate and term refinance. And if you structure the application a certain way, you can do a mortgage up to 95% of the value of the house instead of 80, and you don't pay a higher interest rate like you would with a cash out refinance, because this is considered a rate and term refinance. That $50,000, that buyout amount, is considered a return of equity to a departing owner. And so if you structure this a certain way, you have access to a lot more cash, a lot more home equity than you otherwise would. Now, this can help, close a deal that otherwise wouldn't get closed. And you can also use your equity more strategically. So we've used home equity sometimes in lieu of retirement assets. Instead of paying taxes and penalties on retirement assets, sometimes it may be more financially advantageous to use some home equity instead of that, because there's no taxes to pull out home equity. Also, we've used home equity to consolidate debt, to pay off more debt. We had a case one time where we're able to combine and pay off about $80,000 of credit card debt by using home equity by using this equity buyout option in a more strategic way to pay off all of their revolving debt. So both of them were going to come out of the divorce with about $800 a month better cash flow by not having all of that revolving debt. So there's some things that you can do with home equity if you know how to structure the application and you know what options are available to you that you otherwise wouldn't be able to do. And so when we're working with somebody, we'll go over what options are available, some things that you can do to maybe create, maybe craft a better settlement for you in using that home equity in a smarter, more strategic way. So when it comes to qualifying for a mortgage, so there's basically three types of mortgages out there. There's government regulated, there's government insured, and then there's portfolio loans. So government regulated is in essence your conventional loans, Fannie Mae, Freddie Mac. Minimum credit score for those right now is 600 and 620. You can use up to 97% of the house value with an agreement. If you're using child support and alimony to qualify for a conventional mortgage, you need a 6-month history of receiving it, and it has to continue for 3 years. So broadly speaking, if you kind of think of child support and alimony, 6 and 36. So you're going to need 6 months. Fannie Mae and Freddie Mac said in order to count it, it needs to be stable and ongoing. So stable they define as 6 months. So you have to have a 6-month history. So you have to show either canceled checks or else six months of bank statements showing the transfer from the other person. And it has to be the same amount every single month. If one month it's off by $1, then you got to start all over again. And it has to continue for 3 years, from 3 years from the settlement of the mortgage in order to count it. Otherwise, it's not counted as qualified income. So in the case that I talked about, they structured the alimony over 30 months, and we couldn't count that because it didn't continue for 3 years. Had they simply done the same amount of alimony but just stretched it out to like 37 months, then we could have used it. And then debt ratio with Fannie Mae and Freddie Mac, you can typically go up to 50%, depending upon credit score, depending upon loan to value. The other type of loan is government insured, and this is going to be like FHA is the most common. FHA is going to be a little bit more flexible, a little bit more flexible with credit, and they're going to be a little bit more flexible with your debt to income ratio and then counting child support alimony. So they'll go down to a 580. We can go down lower than that. I mean, I've done them below 580 before. It just gets a little bit more difficult. You have to have a lot of equity in order to do that. So if you owe, half the value of the house, you have a better chance of doing something if you're under 580. You can go up to 96.5% of the value of the house as far as assessing equity. And then also with child support and alimony, you can do as little as 3-month history if there's a court order. So if it's court ordered, then you can do as little as 3-month history. So you only have to show 3 canceled checks or 3 months bank statements with a transfer, but it still has to continue for 3 years. And then debt ratio, they'll go up to 56% debt ratio. And debt ratio is basically just your total debt that's on your credit report, the monthly payment divided by your gross income for the month. And then lastly is portfolio loans or alternative documentation loans. So these types of loans have kind of come up in the last couple of years, and they offer a way to kind of be creative depending upon income and assets. So with a typical mortgage, you're judged on 3 things. You're judged on your credit score, you're judged on your loan to value, and then also your debt ratio. Particularly for people who are self-employed, their cash flow may be better than what they're actually showing on their tax return. So portfolio loans will allow you to use, bank statements, deposits into your bank statements instead of a tax return. Or if you have a lot of assets, they'll allow you to use, your total amount of assets divided by 60 months, and that's qualified based on that monthly income. So it gives people more flexibility. There's some more options. We have about 15 portfolio lenders that we work with. Alimony, child support, you can do as little as 3 months. Still has to continue for 3 years. Debt ratio is up to 50%. So this can give some people some options that they otherwise wouldn't have with a conventional or just a government loan. So a couple of other things to know. So assumptions. I mean, a lot of people asked about assumptions. Well, can I just assume the mortgage from somebody else? Can I just assume the mortgage and then, just put it in my name and keep, everything the same? And that's going to be kind of, we get asked that more often when people are refinancing into a higher interest rate. So the only loans that are really assumable are FHA loans. So normal conventional loans aren't assumable. Secondly is insurance, and this is a big one too. And this is something that's really easy that you can do, but it could potentially save you a lot of headache. People mistakenly think that having insurance, that their house is insured, but that's really not the case. So your insurance policy, your homeowner's policy, insures your interest. The actual policy says insures, John and Sally Doe where they reside. So it ensures your interest in the property, not necessarily the property itself. And the way that insurance policies are written, if you're married, it ensures you and your spouse where you reside. Now, what happens in divorce often is that somebody will move out, and you'll separate before you actually file for divorce. This could potentially void your insurance policy. And the reason is because the policy states ensures, if the policy insures you and your spouse interests where you both reside at 123 Main Street, and one of you moves out of 123 Main Street and moves over to, 890 Main Street, and you set up a residence down there, and something happens to the house, say the house burns down, the insurance company come back and say, well, look, when you left this house, we no longer insured you where you resided. Now, the cases on this are mixed, but if you're in a situation where one of you has moved out, you should make a call to your insurance agent and just let them know and see if you need to make any changes to the policy. It can save you a lot of issues and a lot of headache in case there's a claim. Quick claim deeds. So quick claim deeds, you want to be really careful with these. If you're going to do a quick claim deed and you're not going to change the mortgage and stuff, you could possibly void your title insurance. And every mortgage has what's called a due on sale clause. So if you change the title to the property, the mortgage company can call that note due, or can call your mortgage due. So if I own a property with my wife, and she, I quit claim my interest in the property over to her, and we file that at the courthouse, and the mortgage company finds out about that, then they can call the note due. They would send me a letter saying you have 60 days to pay the mortgage due, or else we're going to foreclose on you. Now, there are some exceptions to that. And it's something called the Garn-St. Germain Act. So if it's due to divorce, if you actually have a divorce decree or settlement agreement saying that you're going to stay in the property and you're responsible for that, and this other person's moving out, and you did a quick claim deed, and it's going to be a longer term thing, there's a letter that you can send your lending institution to let them know that this is what happened, here's why, and under the Garn-St. Germain Act, they can't foreclose on you. If that's your situation, just send me an email or something like that, and I can send you the language and the instructions on how to do that. So again, thank you so much for taking the time to be on the webinar. I hope you found it informative. Hope you found some things to consider that you may not have been considering before. I work differently than most other professionals, financial advisors, CPAs, attorneys, and stuff. I'm basically free, so I don't get paid unless I close a loan. So I don't get retainers. There's no application fees. There's nothing like that. So if you have questions, if you have specific questions about your case, or something that you want to discuss, I'm happy to schedule a phone call with you, answer your questions. We do pre-approvals for free. Everything's basically for free until you close on the loan. If you want to proceed with the loan, and getting pre-approved and stuff, and getting all of your house documents together for you and your attorney for your settlement, the only thing that we would charge for it would be the appraisal. The appraiser gets paid when he does the work. Other than that, everything else is free. So feel free to use me as a resource if there's anything I can do for you. Anything, any questions you have, or scenarios or anything, I'm happy to talk to you and walk you through anything, or give you any advice or anything that I can. So again, thank you very much for joining me. I appreciate it, and we hope to hear from you. Thank you.